the banks have no limit on what they can short. So if J.P. Morgan, HSBC, or whoever it is, wants to short a couple 100 million ounces of silver tomorrow, no big deal. They can do it on a click of a mouse. And it's pretty shocking that they...
You're watching Silver News Daily. Subscribe for more. Keith Neumeyer, a renowned name in the silver market, has made a staggering prediction. Silver prices could soar to $1,000 per ounce. This forecast is based on a critical factor most investors overlook: the massive short positions held by major banks. Today, we'll delve into why this could be a game changer for silver and your investments. Trust me, you won't want to miss this.
We have to be quite careful of what we say publicly, but I can tell you, 20 years in, I built this portfolio that we currently have, through acquisitions. And, we're always looking around and I hope to see, over the next, couple of years, another major acquisition, hopefully then, continually try to, build our business. And that's what I like to do. And we're already one of the larger silver companies in the space. And I always have objectives and goals to be a lot bigger.
Keith Neumeyer is a name that resonates with authority in the world of precious metals, especially silver. As the founder and CEO of First Majestic Silver Corp., Neumeyer has over 3 decades of experience in the mining industry. His insights and predictions have often made waves in financial circles, earning him a reputation as a visionary in the sector. Neumeyer's deep understanding of market dynamics and his outspoken views on silver manipulation have positioned him as a trusted voice among investors. His prediction that silver could reach $1,000 per ounce isn't just speculation, it's grounded in years of industry expertise and a keen eye on market trends. Why should you pay attention to what Keith Neumeyer says? His track record of accurate forecasts and his role in leading one of the largest primary silver-producing companies in the world make his opinions highly influential. As we explore his bold prediction, it's crucial to understand the weight his words carry in the financial community.
And that's all, the shorts are trying to dissuade individuals like ourselves to, put money into this as an investment into silver. It doesn't affect the industry because it doesn't cost, for a BMW, whether it's 30 grams or 40 grams of silver, in an electric car, whatever the number is, and it's a highly held secret of exactly how much silver is in any kind of automobile or any kind of device that we consume as a human race, because all these numbers are kept, very close to the chest. But nevertheless, it's quite irrelevant if silver is $100 or $200 or $300, compared to the price of an automobile. So, but yet the banks are short hundreds of millions of ounces, and they're feeling the pain today. And I know that for a fact. We deal with the physical market, and yet as a miner, we sell our ounces, and we have to sell our ounces because we're not in the business of hoarding our own ounces. Our institutional investors expect us to take advantage of the current metal prices, and they want to see those revenues and those profits, and that affects the analysts, and that affects the target prices they put on our stock, and that affects the shareholders who own. We have 80,000 shareholders worldwide. If all of a sudden we have no revenues, then that's not going to be very good for our share price. So we have to take advantage of the current metal prices, which we do and are doing right now. But it's interesting because the bank limits that a lot of these traders have hit their limits. Which I remember going back to 2011, the same phenomenon occurred, but it was so long ago that I kind of forgot about it. But now, as a miner, the gold producers and silver producers out there, they're having issues selling metal at current metal prices because all the credit limits are all at their limits throughout the entire banking system. Because there's a delay from the time we sell our ounces to the time we actually deliver the ounces. And that could be a 30-day delay, it could be 60 days, it could be 90 days. And that difference is financed. And the banks finance that on behalf of the mining sector.
To grasp the magnitude of Keith Neumeyer's prediction, it's essential to understand the concept of short positions and how they influence the silver market. Short positions occur when investors borrow silver shares and sell them, hoping to repurchase them at a lower price to make a profit. This practice, while common, can significantly impact market prices, especially when done on a large scale by major banks. In the case of silver, several large financial institutions hold substantial short positions. This means they have bet heavily on the price of silver falling. These positions can create downward pressure on the market, making it difficult for silver prices to rise naturally. However, when these short positions are eventually covered, meaning the borrowed shares are bought back, it can lead to a sharp increase in prices. This phenomenon, known as a short squeeze, can cause rapid and dramatic price movements. Neumayer believes that if these significant short positions are addressed, it could remove the artificial suppression on silver prices, allowing them to soar to their true market value, potentially reaching $1,000 per ounce. Understanding this dynamic is crucial for investors. The interplay between short positions and market prices can create opportunities for significant gains, but it also comes with risks. By analyzing these positions, investors can better navigate the market and make informed decisions.
Your biggest cost is energy, basically, and the second would be manpower. But they're quite low cost. You look at an open pit mine. You could be $2 or $3 mining costs, and maybe total all in costs could be south of $50 after processing and everything else. You look at an underground mine, and you're going to be north of 100, and some underground mines are even higher than 300. I've seen. So, it's a totally different economics, and it comes down to geology, comes down to jurisdiction, and it comes down to metallurgy as well. Can the metal be taken out of the rock economically? What kind of chemicals you need to use to do it, and what kind of plant you need to build, and so on and so forth. So it's not an easy answer, Dunnigan, but it's I don't know what the problem with open pit mining is. Quite honestly, you're building a future lake for the local animal life. You can put some fish in it and put some houses around it, and have a nice little environment. Once the mine is gone, you can have a beautiful area to vacation in, and it's very short-sighted. Sure, if you fly over an open pit mine, does it look bad? Well, it's a hole in the ground. Doesn't look bad to me. It excites me personally because I see all the engineering and all the hard work and all the wealth that's being created as a result of those efforts. I know how difficult it is for a company to get to that point, and I also know how much wealth it creates and then the benefits that wealth generates. So that's how I look at it. If politicians have a different view when they fly over a hole in the ground or a hole in this Earth's surface, and they somehow think it's negative, well, I don't know. I don't understand that, quite frankly, but it's very short-sighted as far as I'm.
Market manipulation in silver is not a new phenomenon. To understand the current situation, we need to look back at some notable historical events that have shaped the market dynamics. One of the most infamous cases of silver market manipulation occurred in the late 1970s and early 1980s with the Hunt brothers. The Hunt brothers, Nelson and William, attempted to corner the silver market by buying vast quantities of physical silver. Their actions drove the price of silver from $6 per ounce in early 1979 to a peak of $49.45 in January 1980. However, their manipulation eventually led to a market collapse known as Silver Thursday, where the price plummeted and the Hunt brothers faced massive financial losses. Fast forward to more recent times, the manipulation narrative has evolved. Today, the focus is on major banks and their alleged roles in suppressing silver prices through massive short positions and high-frequency trading. Institutions like J.P. Morgan and HSBC have faced accusations and even fines for their involvement in manipulating silver prices. For instance, J.P. Morgan was fined nearly $1 billion in 2020 for manipulative practices in the precious metals market. The impact of these manipulative actions is significant. When large entities hold substantial short positions, they can create a false impression of lower demand, driving prices down artificially. This suppression prevents silver from reaching its true market potential. Understanding this historical context is crucial as it highlights the ongoing challenges and the potential for future price corrections. As Keith Neumayer suggests, addressing these manipulations could lead to a more transparent and fair market, potentially allowing silver prices to surge to unprecedented levels.
Loosen out their permitting, or Nevada or Arizona, or Canada, where most of these metals come from, we could produce more metals as an industry. But for the mining sector, and I'm the chairman of a company called First Mining Gold, which many of your listeners probably are familiar with. We've been working for 7 years on a permit. The asset was discovered in 2010. It's now 2024, 14 years after discovery, and still hasn't got a permit. We're not expecting a permit for probably the next 2 to 3 years. And that's if everything goes smoothly. So the burn rate on that permit is about $20 million a year. So over that 20-year period, it costs around $300 to $400 million just to get the permit. Then you have to break ground and build the mill, which is going to be another $600, $700, $800 million. So how long is it going to take you to get payback on that? So institutional investors, they don't have the patience. So you go to an institution and say, I want $50 million, I'll pay you back in 20 years. They're going to laugh at you. So it's a very difficult industry, very tough to raise money for, and it's a long game. And you have to have patience as an investor, but you have to have patience as a management team. And at First Majestic, I think we've proven ourselves, over the last 20 years. But it is a big challenge. Talking about silver, talk to the governments and ask them the question: why don't they put silver on the strategic metals list? If they did, then maybe governments would wake up and say, hey, look, we need this metal, and we're going to fast track permitting. And rather than taking 20 years to get a permit, we'll do it in 3 years. And if they did that, then we could potentially get silver ounces produced, or more silver ounces produced on an annual basis. Sorry for such.
Silver prices are influenced not just by market manipulation, but also by regulatory constraints and supply challenges. Regulatory bodies like the U.S. Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, play a critical role in overseeing and regulating the trading activities in the silver market. However, these regulations can sometimes be a double-edged sword. On one hand, regulations are designed to prevent market abuses such as insider trading and price manipulation. They aim to create a level playing field for all market participants. On the other hand, regulatory loopholes and enforcement challenges can allow large financial institutions to exploit the system. Despite fines and penalties, these entities often find ways to continue their manipulative practices, keeping silver prices artificially low. Another significant factor affecting silver prices is the supply side. Silver mining is fraught with challenges, including declining ore grades, high extraction costs, and environmental concerns. Many of the world's major silver mines are aging, leading to decreased production. Additionally, political instability in key mining regions can disrupt supply chains, further constraining the availability of silver. Recycling of silver, which accounts for a substantial portion of supply, also faces limitations. The amount of silver recovered from scrap is influenced by economic conditions and the market price of silver. When prices are low, the incentive to recycle diminishes, reducing the overall supply. Keith Neumeyer points out that these supply constraints, coupled with regulatory challenges, create a perfect storm for potential price increases. As demand for silver continues to rise, particularly from industrial applications and investment, addressing these supply issues is crucial. If the regulatory environment can be improved to curb manipulation and the supply constraints are managed effectively, silver prices could reflect their true market value, possibly reaching the $1,000 per ounce mark as Neumeyer predicts.
I know this industry quite well, and when you see management teams doing resource estimates at $1,400 an ounce gold or $1,600 an ounce gold, which we're seeing regularly now. It used to be $1,200. Now they've moved their numbers up. I'm talking about the big gold players out there. It tells you, and it tells the institutions that the executive teams that are running these big businesses aren't bullish on the metal that they're producing. If they would actually do the numbers at spot, the economics of the economics of basically every mine on the planet would all of a sudden become economic. But they don't want to do that because they don't want to be under the criticism of the regulators or the banks. So they're automatically conservative. So they shoot themselves on the foot just by using lower metal prices just to save them. Yet what that ultimately does, it prevents them from making the investments necessary to grow those assets.
Keith Neumeyer's bold prediction that silver prices could soar to $1,000 per ounce is not just an arbitrary figure. His analysis is grounded in a deep understanding of market dynamics and the underlying factors that drive silver prices. Let's delve into the key points that form the basis of his prediction. First and foremost, Neumeyer emphasizes the significant impact of the substantial short positions held by major banks. These short positions have long suppressed silver prices, creating an artificial ceiling that prevents the metal from reaching its true market value. Neumeyer argues that once these short positions are addressed, either through regulatory action or market forces, silver prices will be free to rise significantly. Secondly, he highlights the increasing industrial demand for silver. Silver is a critical component in various industries, including electronics, solar energy, and medical applications. As the world moves towards green energy solutions and technological advancements, the demand for silver is expected to grow exponentially. This rising demand, coupled with constrained supply, creates a perfect scenario for a price surge. Furthermore, Neumeyer points to the historical undervaluation of silver compared to gold. The gold-to-silver ratio, which measures the amount of silver it takes to purchase 1 ounce of gold, has been historically high. This indicates that silver is undervalued relative to gold, suggesting significant upside potential if the ratio returns to historical norms. Neumeyer also considers the broader economic environment. With global economic uncertainties, inflationary pressures, and concerns about the stability of fiat currencies, precious metals like silver are becoming increasingly attractive as safe haven assets. Investors are seeking tangible assets to protect their wealth, and silver, with its dual role as both an industrial metal and a store of value, stands to benefit greatly. Lastly, Neumeyer underscores the role of investor sentiment and market psychology. As more investors recognize the potential for substantial gains in silver, there could be a surge in buying activity. This increased demand, driven by both institutional and retail investors, could further propel silver prices upward.
I think, and you did it to me again. So to answer your first question, you would have to get the regulators to put a limit on the banks. So right now there's no limit. The banks have no limit on what they can short. So if you know JP Morgan, HSBC, whoever it is, wants to short a couple 100 million ounces of silver tomorrow, no big deal. They can do it on a click of a mouse. And it's pretty shocking that they can do that. There should be a system in place whereby, you know, we know what the world supply of silver is. It's about 820 million ounces last year, approximately. So, you know, the bank should be just like a regular bank. You're allowed to go 10 times above your deposits. So you can't expose your bank, you know, more than 10 times than what you currently have from your clients on deposit today. So that's a number. 10 times is what the banking system uses to manage their books, and I think the paper market should be the same thing. So if you limit, you got 820 million ounces of production, you limit the banks to 8.2 billion ounces at any given time. That at least limits them, and they can't go beyond that number, and that gives the producers at least a little bit of room to make a little bit of extra money. And what does a producer do? And this is really what drives me crazy: is producers supply communities with wealth. You know, we educate thousands of children. The schools in the communities that we're active in were built by us in many cases. We supply the water infrastructure, the electrical infrastructure, the internet. We supply computers, you know, pencils, papers, garbage collection, waste collection. We do everything. If it wasn't for a mine in a small town in the middle of nowhere, these communities.
Keith Neumeyer's prediction of $1,000 silver has sparked a variety of reactions within the market. Some experts are highly supportive, while others remain skeptical. Let's explore the different perspectives and what they mean for investors. On one side, many market analysts and silver enthusiasts agree with Neumeyer's assessment. They point to the historical manipulation of silver prices and argue that the market is due for a significant correction. Analysts who support this view believe that the combination of increased industrial demand, constrained supply, and the unwinding of short positions could lead to a dramatic rise in silver prices. These experts often cite recent fines and legal actions against major banks as evidence that market manipulation is being addressed, which could pave the way for higher prices. For instance, Michael Maloney, a well-known precious metals advisor, has echoed similar sentiments, suggesting that silver is significantly undervalued and poised for a major breakout. He highlights the increasing use of silver in green technologies and the potential for a supply squeeze as key factors that could drive prices higher. On the other hand, some financial analysts remain cautious. They argue that while the fundamentals for silver are strong, reaching $1,000 per ounce is overly optimistic. These skeptics point to the large size of the silver market and the potential for substitution with other metals in industrial applications if prices rise too sharply. They also caution that market manipulation, while problematic, is unlikely to be completely eradicated, and thus the price suppression might continue to some extent. Economist Nouriel Roubini, for example, acknowledges the positive outlook for silver, but warns that such high price targets may not be achievable in the near term. He suggests that while silver will likely see significant gains, investors should remain grounded in their expectations and be prepared for volatility. Additionally, some experts bring up the issue of liquidity and the market's ability to absorb large volumes of investment without causing excessive price swings. They argue that a sudden influx of investment could lead to short-term spikes, but may not sustain long-term price levels at $1,000. Despite the differing opinions, one thing is clear: Neumeyer's prediction has reignited interest and debate around silver. For investors, this means staying informed and considering both the bullish and bearish perspectives when making investment decisions. While the path to $1,000 silver might be fraught with challenges, understanding these diverse viewpoints can help in navigating the market effectively.
These wouldn't exist, and these children would not get educated, and they would not go into universities and would not have a sustainable life. They'd be living in poverty. And yet the banks don't want the metal prices to go higher. So who are they actually hurting? They're actually hurting these small little communities around the world who can't get proper price for the commodities that these communities are producing. And it's quite shocking, and that more politicians don't come to the forefront and argue this point. And I'm always out there saying, hey, look, who are you hurting? Really, you drive through these small towns, and I've been through many of them. And from the early days in Africa, to my current position, in Mexico, it's the amount of wealth that the mining sector creates is phenomenal. Yet, we don't get the support from the governments because they don't want to, walk away from their desks and travel to these communities and see these, young kids walk around school uniforms with computers in their hands and, wonder where all this money came from, right? It didn't come from the government, I can tell you that. So anyways, going to supply. I don't see any reason why supply is going to increase. I don't know of a large mine that's going to be coming online anytime soon. There's a lot of unpermitted mines around the world that could be permitted, but they're not permitted. So that's up to the individual company. You should probably talk to them and get details on what's the issue, because every issue, every jurisdiction, every project has its own unique issues with them and reasons why some permits take longer than others. But that's really what it comes down to, is really permitting. If governments want to see the green revolution continue on the efforts or on the direction that they want, or at least suggesting they want, the mining sector does not produce enough copper, does not produce enough silver, zinc. You go across the board to basically all metals. We're simply not producing enough metals to meet the demands that the governments are suggesting that we try to accomplish over the next 20, 30 years. And they're just, they're oblivious to what's actually going on in the industry. Metal supplies are dropping in front of our eyes, and the politicians aren't.
Keith Neumeyer's prediction of silver reaching $1,000 per ounce has significant implications for investors. Understanding these impacts can help you navigate potential opportunities and risks in the market. First, let's consider the opportunities. If Neumeyer's prediction comes to fruition, early investors in silver stand to gain immensely. Those holding physical silver or shares in silver mining companies could see substantial returns. Silver mining stocks, in particular, might experience exponential growth, as they often provide leveraged exposure to silver prices. Companies like First Majestic Silver, led by Neumeyer himself, could benefit directly from a price surge, making their stocks more attractive to investors. Moreover, silver's dual role as both an industrial and precious metal makes it a unique asset. As industrial demand for silver continues to rise, driven by sectors such as electronics, solar energy, and healthcare, the metal's value proposition strengthens. Investors seeking to diversify their portfolios with assets that have both growth potential and defensive qualities might find silver to be an appealing option. However, it's crucial to acknowledge the risks involved. The silver market is notoriously volatile, and prices can swing dramatically in response to market events. Investing in silver requires a tolerance for risk and a long-term perspective. Short-term price fluctuations might test the resolve of investors, but staying focused on the underlying fundamentals is key. Additionally, there are potential pitfalls related to market manipulation and regulatory changes. Although efforts are being made to curb manipulative practices, the risk of continued interference remains. Investors need to stay informed about regulatory developments and market dynamics to make well-informed decisions. Another factor to consider is liquidity. As interest in silver grows, so does the challenge of maintaining liquidity in the market. Rapid price increases could lead to periods of reduced liquidity, making it harder to buy or sell silver at desired prices. Investors should be prepared for these scenarios and plan their entry and exit strategies accordingly. Finally, diversification is essential. While silver offers exciting prospects, it should be part of a balanced portfolio. Diversifying across various asset classes, including other precious metals like gold, as well as equities and bonds, can help mitigate risks and enhance overall portfolio stability. In conclusion, Keith Neumeyer's prediction opens up exciting possibilities for silver investors. By understanding the potential impacts and maintaining a balanced approach, you can position yourself to capitalize on silver's growth potential while managing the associated risks. Remember, informed and strategic investing is the key to navigating the dynamic world of precious metals.
You have gold on the surface, you get silver, next down from that, then you get your zinc, and then your lead and your copper. Your copper is generally the lowest metal, but there's parts of the world where, due to volcanic history, the whole, geological system's been flipped on its, back, so the copper's on the surface. There's other areas of the world, like Chile, for example, where you had glaciation, and the entire top levels it's been eroded away, so you had copper on the surface. And these are big open pits, and you can't turn those into underground mines. As simple as that. The copper's sitting right on surface, and copper is pretty important. Gold tends to be, obviously more challenging. Due to glaciation, a lot of the gold's been, removed, and it's in the oceans today. So it's gone. Silver's much the same. It really depends on a jurisdictional thing, and what kind of mining is suitable for what type of jurisdiction. In very mountainous climates like the Sierra Madres in Mexico, or even in Canada, some of the throughout British Columbia, you've got a lot of mountainous terrain, and so on. So open pit mining in those regions would not be possible. You're not going to go and take a mountain out just to create a mine. It's just way, way too expensive. So you have to build tunnels and go after those minerals that you have discovered through the drill bit. But if it's underground mining, it's going to have to be higher grade. And this is where the big issue comes from. So open pit mining is cheaper. You don't have to build tunnels, and you just basically dig a hole, and you have trucks, and you go in there. And
Keith Neumeyer's prediction of silver reaching $1,000 per ounce might seem ambitious, but several key factors could make this a reality. Let's break down how this unprecedented rise in silver prices could happen. First, addressing the massive short positions held by major banks is crucial. These short positions have long suppressed silver prices, creating an artificial barrier. As regulatory bodies increase scrutiny and impose stricter regulations, these manipulative practices could be curtailed. If major banks are forced to unwind their short positions, it could trigger a significant short squeeze, propelling silver prices upward rapidly. Secondly, the supply constraints in the silver market cannot be ignored. With declining ore grades and the increasing costs of extraction, new silver production is becoming more challenging. This is compounded by political instability in key mining regions and environmental regulations that limit mining activities. As the supply tightens and demand continues to grow, the imbalance could drive prices higher. Industrial demand for silver is another critical factor. Silver is indispensable in various high-growth sectors, including electronics, solar energy, and medical devices. The push towards green technologies and renewable energy sources is expected to exponentially increase silver consumption. As industries expand and innovate, the demand for silver will likely outpace the available supply, putting upward pressure on prices. Moreover, investor sentiment plays a vital role. In times of economic uncertainty and inflationary pressures, investors flock to safe haven assets like precious metals. Silver, with its dual role as an industrial and precious metal, becomes an attractive option. As more investors recognize its potential, increased buying activity could further drive up prices. Additionally, the historical undervaluation of silver relative to gold suggests a significant upside potential. The gold-to-silver ratio, which has been historically high, indicates that silver is undervalued compared to gold. As market dynamics shift and investors seek value opportunities, silver could see a substantial price correction. Finally, global economic trends and monetary policies will influence silver prices. With central banks around the world adopting loose monetary policies and increasing money supply, inflationary concerns are rising. Precious metals, including silver, are seen as hedges against inflation, attracting more investment into the sector. In conclusion, while reaching $1,000 per ounce for silver is a lofty goal, it is not beyond the realm of possibility. The combination of regulatory changes, supply constraints, growing industrial demand, investor sentiment, and economic factors creates a perfect storm that could drive silver prices to unprecedented heights. As Keith Neumeyer suggests, staying informed and strategically positioned could allow investors to benefit from this potential surge. Remember to subscribe to our channel for more insights and updates on the silver market. And please note that this is not financial or investment advice.
Wow. And the whole rationale behind that, as you know, because you interview tons of people and you're knowledgeable about this space, that there's a leverage in the system of somewhere around, we don't know exactly, but call it 300 to 1. There's something like 250 trading days in a year. Silver paper markets trade something like 1 billion ounces a day. So that's a call. Just round it up to 300 to 1, for argument's sake. We produce 10 million ounces. So 300 times 10 million is 3 billion ounces. So we know the banks leverage our 3 billion ounces, right? Or our 10 million ounces are leveraged to 3 billion paper ounces. So the banks know they're getting our physical metal, and they leverage that in the paper markets because they know it's coming to them. And they know when it's coming to them because we put out public announcements, and the entire mining sector does exactly the same thing we do. So the banks know how much gold's coming into their vaults. The banks know how much silver is coming into their vaults, and they hedge that in the paper markets, which creates this whole, manipulation, if you want to call it. And I'm not sure if that's the right word, but it's basically managing their book, I think is probably the best way of putting it. But nevertheless, it has this constant supply of paper that's being put into the paper market. So during a Reddit squeeze, which did occur, there was a ceiling on the paper market because the banks knew the physical was coming in, and they were happy with the price, and they put a lid on the price in the paper markets. And then next thing you know, the buying dries up because the banks are bigger than the paper buyers. And of course, they know that once the buying dries up, this price of the paper market is going to drop, and they're just going to sit there and buy back all the paper. It's just such a wonderful game, and they love doing it. And they, so what I'm trying to do is pull off those ounces. So if I can pull 3 billion of paper silver ounces out of the market, it's not a lot compared to the amount trades on an annual basis, but at least it's the beginning. And my mission in life is to try to pull as much paper silver out of the market as possible.